what do we make of why the 1 year's down, the 5 years not? Is there any significance why that's so? And just your thoughts on what that means for us moving forward.
Sure. I think number one is after the Central Economic Work Conference and the government prioritized the stability for next year's economic work. So clearly more coordinated monetary and fiscal policy and in a counter-cyclical way, and it should be expected. And so we have forecasted 5 to 10 basis points cuts in policy rates by March next year. So we now see 5 basis points being delivered in LPR. I think the 1 year suggests that they continue to, following their commitment to try to support the small media enterprise or the real economy, lowering the financing costs. But the 5-year LPR tended to be more linked to the mortgage loan. So they are maintaining somewhat of a cautious policy stance on the property sector despite the ongoing downturn.
Well, okay, you're calling now for a policy rate cut. Are things that bad?
We have lowered our 2022 forecast more than a month ago to 4.7% below consensus in view of three considered factors. Number one, housing downturn, which is very visible as seen in the latest data. Despite some earlier signs of stabilization with the contraction narrowing, we see continued headwinds and downward pressure facing the housing market. Second is the China's zero tolerance policy should be maintained through next year. Third, which obviously will drag down consumption and services, as we've seen the November data is being weighed down. And third would be the government facing greater pressure to meet its climate commitment, and that also requires a further slowdown in the heavy industrial production growth. So clearly, I think the economy faces a lot of headwinds and downward pressure, as already been seen. The government now mentioning counter-cyclical policy for the first time in a year.
Now, given all of that, it seems clear we have a policy trough. In terms of that forecast that you have, and you've outlined the challenges ahead, would you say there's downside or upside risk to your 4.7% growth forecast?
I think for now, the risk is somewhat balanced as we see the government continue to roll out somewhat of policy easing measures at a targeted and measured pace as we see the PBOC easing. They have a differentiated LPR rate cut. And despite we are looking for also more proactive fiscal policy, and the experience in the past 3 years tends to show infrastructure, the ceiling is 2 to 3% growth. So we may not be able to count too much on that. So I think for now, the risk is somewhat balanced, although the housing indicator, I think, is our key to watch. In particular, property tax, which is actually in our base case, and we forecast that to drag down home sales by 15% contraction in the next few months. And if the property tax has been delayed, postponed in the next a couple of months, and we may see some slight upside risk to our forecast.
Okay, before I let you go, I need to ask you about your outlook for the currency and de facto your outlook on the balance of payments, which in a lot of ways was very one-sided this year, whether trade, capital flows into the country and just a lack of outflows because tourists are, to your point, the borders are closed, you don't have outbound tourists. Do you expect the forces to remain in favor of a stronger currency next year?
I mean, after so much strength in the Chinese currency in the past year, and obviously it's natural to expect some softness, but we remain constructive on China's, balance of payments, and also not only the portfolio inflow likely will be sustained, and I want to highlight, the foreign direct investment flow, which is also of a much higher magnitude, have resumed post-COVID because China was able to manage the pandemic quite well and resume production quite easily. So I think those shall continue to support inflows into China, and along with a moderating, but I think still a strong export growth in spite of the reopening in the developed markets, because what our research showed that last year it was the developed economies supporting Chinese exports, but this year actually emerging markets demand has been an important driver for Chinese export growth, likely reflecting, they were not able to produce and due to the pandemic.